Hi, everybody. My name is Luisela Sigalski. I'm the job coach from Nationality Service Center, or NSC. I'm part of the Department of Employment Services. And today I'm having a very special guest. His name is Jonathan Barnes. He is the Director of Volunteer Engagement, and he represents a very important nonprofit organization here in Philadelphia. The name of the organization is Campaign for Working Families. Thank you so much for joining us today, Jonathan. I know you have a very, very important topic to talk about and a lot of information to share about this topic today.
Hey, Luisela, thank you for having me. I appreciate this opportunity to talk more about my organization, what we do, and how it's relevant to a lot of your clients. So today, I'm going to talk about taxes. The Campaign for Working Families is a small nonprofit in Philadelphia that was founded in 2003, and the focus and mission of the organization is to connect folks to financial services that help benefit and establish themselves either through tax credits, quality financial services, any sort of saving options, or even public benefits. Our model is during the tax season, we operate usually around 20 tax sites in Philadelphia where folks can get their taxes done for free and apply for public benefits applications, as well as get a debit card or a savings account through partner organizations. They can also have their credits checked and get some counseling on financial services that they might be eligible for, all of which is 100% free. Since our founding in 2003, our tax prep program, we filed over 363,000 tax returns. We have brought in around 443 million in refunds to taxpayers that we've served. We've estimated that that's saved our taxpayers around 67 million in tax preparation and check cashing fees that folks would normally be paying to get their refunds. And last year, we operated around 35 tax sites, both in Philadelphia, surrounding counties, as well as New Jersey. And we had about 550 volunteers who participated and served around 29,000 hours and filed over 33,000 tax returns. So we've been busy. We have a large footprint, and we do our best to serve every person that comes into our door as best we can. So paying taxes is an important thing here in the United States. And basically every person is technically subject to paying a tax on any income that they've earned or received during the year. And the calendar year is January through December. Basically, taxes that are collected help the government to build roads and bridges, provide any type of public education, or any type of service like picking up your garbage, and also other types of social services that you might receive through the government. The vast majority of people are required to file a return every year. Sometimes they don't owe any taxes, but some are still required to file their taxes. Normally, majority of folks who work for an employer often will have a portion of their paycheck go towards their tax liability, or what they might owe in taxes each paycheck. So they end up paying their taxes during the year. And that way, at the end of the year, when they file their taxes, they might get a refund, or they might owe whatever the remaining difference is. Some folks who work as independent contractors, so someone who's like an Uber or Lyft driver, they actually don't have their taxes taken out. Uber and Lyft do not take taxes out of their pay. And so what that means is that person needs to proactively file every 3 months their own taxes, right? How much they made in those 3 months, they're supposed to come up with a calculation and pay that proactively to the government. And that's both the federal government, which is the IRS, Internal Revenue Service, and also to the state and local governments. If someone doesn't have enough taxes taken out of their pay stub, or doesn't pay enough if they're an independent contractor, they might owe taxes when they file their tax return at the end of the year or between January and April. If someone has too much taxes withheld or they pay too much during the year, they will then get a refund of whatever tax that they've overpaid on. So you're never going to just give your money away. You're basically going to pay the tax that's calculated based on how much income you earned and some other factors that we'll go over in a little bit. So, question, why file a tax return? Well, you have to file a tax return if your income is above a certain level. And I can't just tell you what that level is because it depends on your filing status, your age, and type of income that you receive. Sometimes folks will file a return even if they're not required to, and we're currently in a moment where that makes sense, right? We're in the coronavirus pandemic, and so the government was able to issue these stimulus checks, as they call them, to people who had filed their return in the last 2 years. So that was very helpful for folks who had filed the return and had direct deposit into their bank account, because the government could just send them that money directly into their bank, and it took maybe 2 or 3 days for that to happen. And if folks had not filed in the last 2 years, then they had to go through this whole process, and the check was delayed by quite a bit. So sometimes folks also who aren't required to file might have worked for an employer who took out some taxes from their pay stub. Well, if they didn't owe any taxes, then they should be able to get that money back in the form of a refund when they do file their tax return, even if they're not required to. So some people are confused about what a tax refund is. A lot of people just think it's money that the government's giving you. Most of the time, it's not. But a refund is considered to be the amount of money in taxes that you overpaid during the year, right? That is more money than what your tax liability was. And then it also includes any other type of tax credit that you might be eligible to receive, which is based on your situation, filing status, based on whether you have any dependents, how much earned income you have. So there's a bunch of different factors, and we'll go over that as well. So when you begin work with an employer who's going to pay you every 2 weeks in a paycheck or whatever the arrangement is, most of the time you're going to have to fill out a W-4 form. It's a form where you're telling your employer, hey, this is how I want to be taxed during the year, make sure I cover my situation, my tax liability when I file my taxes at the end of the year. So it's a simple form right now, although they've added a bunch of pages to it. So I do suggest that you talk to your employer about filling it out correctly based on your situation. Most people will just fill out their name and address and social security number, and then they will choose their filing status, whether they're single or married, filing separately, whether they're married and filing together, or whether they're single but they have dependents, which means they'd be filing as head of their household. Usually if you check those boxes, the right amount of money will be withheld from your pay stub, so that at the end of the year, you'll cover your liability. And maybe if you overpaid, you'll get that back in the form of a refund.
Jonathan, I do have a question for you.
Sure.
What is the main difference or the major changes between this one and in the previous form?
So before, the old form used to ask you how much, basically, they called them exemptions, and you would list how many people lived in your house. And it wouldn't necessarily be clear that you were claiming that you were supporting those people that lived in your house. And so oftentimes people would say they're a family of 5, and they count themselves. They would list the number 5 as their withholding number.
Okay.
Mean that the government would take out a lot less taxes out of their pay stub every pay period, which would mean often at the end of the year, they would end up owing because they did not have enough taxes taken out. And so
Okay.
the new form is designed to ask more questions to make sure that that doesn't happen and that people have the right amount of taxes taken out. Because ideally, at the end of the year, you don't owe the government and the government doesn't owe you. That's unless, of course, you're eligible for a tax credit. But in
Yeah.
terms of tax liability, that's the end result that they want and technically what you should want, because that means you have more money in your pay stub every 2 weeks during the year rather than having to have extra or too little taken out.
So with this new form, it will I guess it increase the possibility to get money back the following
Yeah,
year.
so it'll just help, it'll ask additional questions to make sure that they're having at least enough taken out during the year so that they will not owe when they file their taxes.
Okay.
So there's a bunch of questions you'll see, steps 2 through 4. Ask additional questions. If your partner works, then you have to maybe do a different calculation because maybe they're making more than you and they're having more taxes taken out. And so you can adjust how much you get taken out of yours because your partner's having more. So there's a bunch of different ways to go through that and try and get the most accurate number to tell the government to withhold out of your biweekly pay stub.
Understood. Thank you.
So I do suggest, though, that folks, because even though they're trying to make this easier and more accurate, of course, now they're asking more questions. And so the form is like 4 or 5, maybe even 6 pages long. So I do recommend that anyone sort of work with their employer or job coach to make sure that they're making the right decisions and they have the right number in there so that they do not end up owing at the end of the year when they could have avoided that situation. So this form basically tells your employer how much you want, how much tax you want taken out of each of your pay stubs every 2 weeks or whenever you get paid. Most people just need to select one of those categories. And like I just said, if you have multiple jobs or your partner also works and there's different scenarios, you want to make sure that you fill out steps 2 through 4 to make sure you come up with that correct number so that you don't have too little taxes taken out or way too much during that. So this is, at the end of the year, this is the form that you should receive from your employer. Oftentimes you'll get this in called quadruplicate, meaning you have 4 copies of the same form. This is the tax document that you would come, if you came to our tax site, you would bring this showing what the amount of money that you earned with your employer during the year. So you can see in box 1, which is right there on the right top part of the screen, you've got $21,689, and you had about $2,488 withheld from federal taxes. So this person had a decent amount of money taken out of their pay stub to pay their taxes during the year, and most likely they've overpaid it, and they're going to get some of that money back. So it's not like the government's giving them money, they're just getting back the difference of what they overpaid during the year. And then, of course, if they qualify for a tax credit, they would get a tax credit. This is the form that if you're an independent contractor, so if you are an Uber or Lyft driver or you have some type of business that you operate, this is going to be the form that you'll be submitting to the IRS. So here is a person who worked for Z Builders, and they were paid $5,500 for the work that they did for Z Builders. Well, clearly there's no taxes were withheld from this person's pay. So as you can see in box 4 that I circled in red, there was no federal income tax withheld, and there was no state tax withheld in box 16. So the person is now liable, right, responsible to pay the tax on that income they earned, because the government's going to say, hey, any income that's earned is taxable. Submit it with your tax return, and we'll figure out how much that you owe on that money. So it's important, if you're receiving a 1099 miscellaneous, which is the name of the form, for miscellaneous income, you are going to have to pay taxes on that income. So I always suggest, if you know you're going to be receiving that, as your tax document, and you're getting paid in lump sums, you need to make sure that you put maybe 10 to 15%, if you can, 20% aside to make sure that you can cover that payment of taxes that you're going to owe at the end of the year, right? And any money, of course, that you put aside that's more than what you need to pay, well, that's just money in your pocket. But you should never not put money aside when you're getting paid cash or a lump sum like this person did on this form 1099. So I mentioned previously that there's different filing status that someone is going to use when filing a tax return. And that filing status has an impact on how their taxes are calculated, right? How the government decides how much money they owe on the income that they've earned. So your filing status determines what tax credits you might be eligible to receive. And it's based on your marital status and, of course, your family situation, whether you have any dependents, family members that you are caring for, and they're living in your home or in special circumstances. If they're parents, they are outside your home. So there are 5 possible scenarios, filing status categories that I'd like to go over, and that are what you'll see on a tax return. The first one is single. That's a basic return, right? Just a single person, not caring for anybody else, only supporting themselves. They would choose this status to file their tax return. Someone who is married, legally married, right, and filing with that person here in the United States together, where they're both physically present here, they would choose married filing jointly. And this is the most advantageous tax status that there is. And we'll go over that in a little bit, so you'll understand why. Then there's certain situations where people are married, but they're living or filing separately. This is not a very good filing status. We try to make folks not use this if they cannot, if they can avoid it, just because you don't qualify for any tax credit if you're filing under this status.
In what cases people mark that option, the married filing separately?
Sometimes they think, so if one of the spouses has, say, a lot of student debt or some other type of debt, they owe the IRS money or something, they sometimes think separating their finances is a better status because they don't want their partner to also be burdened, have their tax refund taken to cover the other person's debt with the IRS or whatever the situation.
Oh, I understand.
So a lot of people think in their heads, well, this is the right way to do it. But there's actually a whole other way to do it where you can still file as married filing jointly, qualify for all those tax credits that you might be eligible for, which could amount to thousands of dollars. And then there's a way to separate that spouse who might have that debt or that, whatever it is with the IRS, they can separate that out. And so that the other spouse can still receive those tax credits. So now if someone's living separately, but they're still married, well, then they're going to have to file married filing separately.
And what about those couples who are not legally married, but they live together? They do everything the same thing married couples do. Right. What would be that case?
Only up until 2005 did the state of Pennsylvania recognize common law marriages. So after that, they'd be considered single. And if one of them had dependents that they are caring for, they could file as head of household, which is a category. But they would have to have a legal, which they live, would have to recognize their marriage.
Okay.
Head of household is for someone who is a single parent who has dependents that they're caring for. And this is the best status for them to file in rather than single, because then they qualify for additional tax credits. And then a qualifying widower is someone who has lost their spouse who's deceased within the last 2 years. They would still get a married filing joint credit status, which would qualify for them for those different credits, but they can only claim that for 2 years within the date of their spouse passing away. So if someone qualifies for more than one status, well, they can always choose the best status that gives them the best opportunities to access different credits. So you always want to make sure that you're claiming the best status. So if you're head of household, right, you're a single parent and you have 2 kids, well, you're going to qualify to file as single, but it's more advantageous, of course, for you to file as head of household because you qualify for additional tax credits that way. So I'm talking about deduction now, and basically a tax deduction lowers your taxable income. So a tax deduction basically comes in 2 forms, the standard deduction and an itemized deduction. These are technical terms that honestly, I don't know why they have to be so complicated, but you would either choose a standard deduction, which is a set amount of money that the government determines every year, or an itemized deduction, whichever is greater. So for 2019, for this last tax year, right, which is the current year that we're filing in, the deductions for the different filing statuses were single was $12,200, married filing jointly, as you can see, is the best status. You got $24,400. Married filing separately, again, not a good status. You're back to single there. Head of household is a good status as well because you get to deduct $18,350. And then the qualifying widower, which is sort of a temporary status, is the same as a married filing jointly. So I will explain how this works. So someone who has income, right, automatically gets to deduct either their standard deduction amount or their itemized deduction amount. So here's an example of someone taking the standard deduction, meaning their other expenses and things that they had during the year do not amount to more than what the standard deduction is of $24,400. So someone who makes $35,000 is not going to get taxed on $35,000, right? The government recognizes that there's expenses and things that people are going to face during the year, and to tax somebody at the full rate at $35,000 would not be fair. Excuse me. And therefore, they have these standard deduction amounts that you can subtract from your income. So a married filing joint return gets to automatically deduct, right, for the standard deduction of $24,400. So 35,000 minus 24,400 brings their income down to about $10,600. So even though this couple made $35,000 last year, the government does not tax them on $35,000. They're just going to tax them on the $10,600. So if you take a simple math, if you say their tax rate is 10%, well, 10% of 35,000 is $3,500. That's a lot of money to pay in taxes during the year. But instead, the client was actually, or the couple was only liable to pay about $1,060 if you do 10% of 10,600, which is less. So it's important to recognize that certain amount, once you handle or you apply the standard deduction or whichever deduction you're taking, plus any adjustments and any tax credits, your income is going to be, your taxable income is going to be considerably less.
Yeah.
Does that make sense?
Yeah, it does.
Okay. So moving on, we can talk about who gets to be claimed as a dependent. All dependents must meet these requirements in order to qualify under the tax code. So they must be a U.S. citizen, U.S. national, or a resident alien. Now, a resident alien is not someone who holds a green card, but is someone who has been in the United States for a certain period of time, which is over 183 days, during the last number of years. So it's a formula that the IRS uses, and it's not connected to any person's immigration record or how the USCIS calculates
Oh, okay. It's
someone's status.
different. Yeah.
Yeah, so they use the term resident alien, which a lot of people think is, oh, someone with a green card. Actually, no.
Yeah, it's confusing. I know what you're
Yeah.
saying. Yeah.
Yeah. So that's not how the IRS figures if someone's a resident alien or not.
Mm.
So they must have a social security number. So the Trump administration has made things a lot more strict as to who qualifies for certain tax credits, right? And so they have been very strict about certain dependent tax credits being restricted to someone with a social security number and not an ITIN, which is very unfortunate. And hopefully in the next administration, we can change this and make it, again, once open up to anyone who's here in the United States who might have a social security number or an ITIN. And some dependents, if they're older, they could be working, they can still file their own tax return and even be married in some limited circumstances. It's just certain requirements that they must meet in order to be included on someone else's tax. So qualifying child, we've got, this previous slide was about dependents, now we've got a qualifying child. So there's a relationship test that the child has to be related to you by blood or by law. So examples would be son, daughter, stepchild, foster child, brother, sister, stepchild, stepsister, or descendant of any of these, okay? So it's quite a broad range there, but the important thing to remember is related to you by blood or by law. So for the age requirement, they must be 18 or younger at the end of the year, or if they're in school, in university or college, they have to be 24 or under.
Okay.
And if your child can be of any age, if they're permanently and totally disabled and designated so by the state. So in terms of residency, so we've got a relationship test, we've got an age test, now we've got a residency test. Child live with you, or in the United States for more than half of the year. The question will be asked during tax preparation if you have dependents that you're listing. That child live with you for at least half of the year. So on the previous slide, a joint return, the child cannot file a joint return if they're going to be claimed on someone else's return as a dependent. And then the child must not have provided more than 50% or half of his or her own support for that year. You're claiming a child, you have to make sure that they're related to you by blood or by law, age 18 or certain other ages depending on the credit that you're applying for, that you in the United States for at least half the year and provided more than 50% of their own support for that. So here's a question: what is the maximum income a child can earn and stay dependent on their parents' tax return? Surprisingly, there is no support test for this. If your child did not provide more than half of their own support for the year, you can still claim them as your dependent. This is sort of a limited situation, but I think it's still a good question. There are different types of credits. You heard mentioned different tax credits that increase someone's refund if they're eligible for it.
Yeah.
There's the child and dependent care credit. Allows your taxpayers to reduce their tax by a portion of qualified care expenses paid. So basically it means that if, say in that previous example, right, that client, that couple had earned $35,000, they took away their standard deduction, they had about $10,600 of income, say $2,000 in childcare expenses, and they owed $2,000 on that $10,000 income that they had, well, that child care dependent credit would wipe out that tax liability and they would not owe any taxes on that money they earned last year because the government is considering that the money that they paid for their child care expenses can be towards their tax liability. To qualify for this credit, their child that they're paying dependent care expenses for has to be under the age of 13.
Mm.
Or if it's their spouse that they're claiming this credit for, the spouse has to be unable to care for themselves in any sort of way. Same with the child. And the credit ranges from 20 to 35% of expenses according to AGI. So basically what that means is, and maybe my example wasn't that clear, but basically you get to claim, depending on how much you paid in those dependent care expenses, you claim, depending on your filing status, your income, and a bunch of other circumstances, you get to claim 20 to 35% of those expenses towards your tax liability. So it's easier to see this play out on paper than it is sort of just talking about it. But it's important for folks to know that if they are paying child or dependent care expenses during the year, they should definitely make sure that they're, when they file their taxes, that they're getting credit for that money. So they might have to go to their child care provider and request that tax document that has that information on there that they would then give to the tax preparer. Did you have a question?
Yeah, no, I guess based on what you just said, so if there's parents who pay for their childcare in cash, I guess there's no way they can apply for that credit, right?
Well, no, because the child care provider would give them the form, and the form is basically the name of the child care provider, the employer, basically the tax ID number for the business operating under, and the amounts that they paid per child. So as long as they have that form, the tax preparer can enter that into the system.
Yeah, makes sense.
So it doesn't matter how they pay for those expenses, as long as they have that document to give to their tax preparer.
Yeah, I got that question the other day from one of our clients. She's working in there's a person who is in charge of watching her child while she's working, but she pays that person in cash. So
Oh, yeah.
yeah. So she was asking me, she was able to report that money, right, and get credit for it. But based on your explanation, obviously the answer is no.
Right. Yeah. Right, and then that's what is considered a non-refundable credit. So that means that if that person has to have some income that's considered taxable, and therefore they owe a tax on that money, and that's the only time that credit comes into play, because that's only when it benefits, is when it wipes out a portion or all of that tax liability that they have. So someone who's not, say they don't owe any taxes on the income they earned, well, this credit wouldn't do them any good because they already don't owe the government any tax. You see what I'm saying? So there's different types of credits. A non-refundable credit means money that gets applied toward your tax balance, and then a refundable credit, which is money that you actually get back in your pocket to be spent on whatever it is that you need to spend.
Yeah.
This is an example of a non-refundable credit. Looking at a qualifying relative, there are additional requirements to qualify. The person can't have a yearly income of over at least $4,000. The person can't be a qualifying child dependent of another person, right? Only one Social Security number can be claimed on each tax return. So if someone is in a qualifying relative on another person's tax return, well, they can't be claimed twice, so they can only be claimed on a single so if someone is supposed to claim a person and somehow you claim that person before them, well, then there'll be an investigation, because that second person who's trying to claim that person and who's supposed to claim that person, because they meet the requirements to claim that person, their return would be rejected by the IRS, electronically would be rejected, and they'd have to mail it in, and then the IRS would conduct an investigation to figure out who is eligible to claim that person. And then once they made the determination, the person who improperly claimed that person would have to pay back any tax credit that they would have received for having claimed that child. So it's really important that a conversation is had if there is maybe a couple that's split up and the child lives in two different households. Well, you have to come up with an agreement. Who's going to claim that child on the tax return, because only one person can, right? And so the person must be related to you or must have lived with you for the full calendar year. Someone who's just living on your couch in your basement, well, you can get a tax credit for them as long as you are providing their support and they meet the other requirements. But they, of course, can't have supported their own self, right? They couldn't have, they have to be that person living in your basement on your couch, not
Yeah.
support for themselves.
Yeah.
This is a question that comes up a lot. Can I claim my parents who are not working?
That's a very good question.
So you can claim them as long as they meet, of course, certain requirements. The IRS is all about requirements. So they'd have to meet the dependent test, right? They'd have to be able to qualify as your dependent, and we just went over that previously. They can't have an income of over $4,000, and you have to have provided more than half of their support during the year. And even if they do not live with you, you can still claim them. So they don't have to be living in your household, but you do have to have provided that support for them. A child tax credit, this is an important thing. Most folks who have dependents are going to be eligible for a child tax credit. And this is basically it's intended to offset the expenses that someone has for raising a child. And so this is the government's way of saying, all right, we recognize you have a lot of expenses and we're going to either reduce your tax liability based on this, your situation, or even give you a refundable credit, basically give you money at the end of the year based on your situation. So there's 6 requirements for qualifying for the child tax credit. Age. So the child must be 16 years or younger, right? So under the age 17 during the calendar year to be considered eligible for your tax credit. They must be a citizen of the United States, a United States national or a resident alien, right? So again, that resident alien is not someone with a green card, but someone who's been in the United States for a certain period of time under the U.S., under the IRS's standard of someone present here. They must be a child claimed as a dependent on your tax return, so you must be claiming them. Here's the relationship test, right? They must be related to you in one of the following ways. And you see that listed out: son, daughter, stepson, stepdaughter, etc. This includes any legally or fostered child as well. And they must have lived with you for more than half of the year. And the child must not have provided their own support, right? So you must have provided more than 50% of their support during the year. EITC, that's it's an acronym that gets thrown around a lot. And you'll see it on buses in the city of Philly, or you'll see it in mailers that you might receive. EIT stands for the Earned Income Tax Credit. And it's basically a credit that's been around for the last 50 years. And the idea is to promote people working and earning income rather than receiving income passively, like either through the government or through some stocks and bonds. Earned income is when you're going out and getting a pay stub or paycheck for work that you're doing. That's what the IRS considers to be earned. And so this is a credit to give to someone to incentivize them to have that job. And we'll go over the numbers, but it's pretty much anyone under 55,000 or below, depending on the situation, would qualify for this credit. And it reduces any of the tax that you might owe at the end of the year based on how much you made and your filing status and number of dependents, blah, blah, blah. And in some circumstances, you actually can get a refund, meaning you get money in your pocket based on your situation. So the amount of EITC, earned income tax credit, depends on your income, the number of children that you have, if it's a single person or a couple. And so there's certain requirements that must be met in order to benefit from this credit. And in the Trump administration, once again, in their hateful behavior, has caused this to be restricted to anyone with just a Social Security number. Before, anyone with an ITIN also qualified under previous administrations, but currently under the new tax law, anyone only with a Social Security number can qualify. So maximum credit amount. So for this year, or for currently for the 2019 tax year, folks can qualify if up to $6,660 if they had 3 or more qualifying children. So based on someone's situation and how much they earned, they could receive in the form of money in their bank account of $6,660. So it's quite a lot of money that someone could benefit from. But someone who would qualify for that maximum amount would be not have earned very much income and therefore living on very little during the year. And so this is the government's attempt to sort of boost them in that situation, to give them a little bit more money in their pocket. If you had 2 children, the maximum amount you could get is $5,920. With 1 child, $3,584. And if you're single, you could only get up to $538. So it's really a credit that's benefiting people who are raising dependents or caring for dependents. So again, these numbers, you don't just get these amounts, you get this amount based on how much you earn and based on number of dependents that you have. So just because you have 3 or more qualifying children doesn't mean you get $6,666. You're going to get a portion of that based on how much you earned and where you fall in the spectrum of eligibility. So
it really is based on how much you earn, not for how long you worked that previous year.
Just how much you earned, right? That's the only calculation. Yep. So if you didn't have a job all year and in November, December, you earned $18,000.
Okay.
If there's nothing else on the book showing that you had any other type of income, $1,000 is kind of in the sweet spot. If you have 2 or more qualifying children, you would benefit. You'd probably get close to the maximum amount based on that. So yeah, it's really just on what the government sees as the income that you've earned during that year.
Okay. Okay.
So there's other tax credits that are important to think about. The child tax credits, as we spoke about already, they can reduce your tax liability and then can be refundable up to $1,400 per child. So like I said, there's a refundable credit and a non-refundable credit. The non-refundable credit gets applied against what you owe in taxes, or what we call tax liability. And the refundable credit is once you've covered your tax liability, well, you're going to get back a refundable portion. And with the child tax credit, you're going to get up to $1,400 per child in your bank account, deposited into your bank account. Some who are in school, technically like in college, or some certification program post high school can qualify up to $1,000 in a refundable credit. So you always, if you're in school or you have a child that's in school and they're under age 24 and you can claim them on your tax return, well, make sure you get that tax document from whatever school they're going to see whether it helps to see they've qualify or enables you to qualify for a tax credit for having supported them during that time, and of course, towards paying their tuition to attend that institution.
And what about Jonathan? If you get enrolled in a training program, whether in person or online, or certificate program, this type of type of education, do they fall under the education credits as tax credits or not?
Yeah, so there's two types of credits. There's it's called the American Opportunity Credit. That is for anyone who's going to undergrad, right? So the first 4 years of their bachelor degree. They qualify up to $1,000 in a refundable credit, meaning they can get $1,000 back in the form of a refund when they file their taxes based on how much income, how much they pay in tuition, or how much they owe in tuition to that institution. So they can only claim that when they're in the first 4 years of their bachelor degree. Then if someone's in a certificate program with, whether it's online or whatever, a lifelong learning credit, that is a non-refundable credit. So, right?
Oh, okay.
Tax liability, but you do not get money back for any money that you've paid toward, right, or that certificate.
Okay.
So, it helps reduce your tax liability, but it's not a refundable credit, so you don't get any money back for any of the tuition that you've paid to that institution. You just get to reduce any taxes you owe on the income that you earned during that year.
Okay. Yeah. Yeah. I'm asking actually because it happened to me about 3 years ago. I did this certificate program, and I was wondering that does it qualify or not?
Yeah, it depends on the institution and what you're going for, but most of the time it does. There's certain circumstances that it doesn't, but the institution itself, most people have online accounts now. And so when someone comes to our tax site, we just say, hey, pull up your account on your phone and go to the tax section of your student account, a tax document there. If, the tuition that you're paying for to this institution is eligible to be claimed within your taxes. So most do. There are situations where they don't.
Yeah, good to know.
Okay. And that's the form for that is called a 1098-T. And you would find that in your student account, probably in the financial section or something like that. So I put together here a tax return. It's kind of hard if you're just listening and watching this podcast. But the idea is to give you an idea of how someone's tax return is calculated. If you want to look, I mean, I can run through this, Luisela. You can tell me whether it's worth it or not. But it's my way of showing how the government calculates someone's tax.
Yeah, I think it's a good example. Yeah, go ahead.
Okay. So this person, right, has a social security number. They live in the United States. They have a dependent who also has a social security number and qualifies as their child dependent. Okay. So this person is a single parent with a dependent. So their filing status is going to be head of household, right? They're not going to file as single, but they want to file as head of household because that standard deduction amount that they get to subtract from their income is the $18,000 versus the $12,000 that it would be for single. So the most advantageous status for them to file is head of household. So as we see here on line 1, Ms. Bobali has earned $35,000 at her place of employment. Now, if you look on line 8A, the next number down, she had she paid up to $2,500 in student loan interest, and that is considered an adjustment, which I didn't really go over in this presentation. But an adjustment is an amount of money that you can subtract from the gross, the total amount of money that you earn. So even though she made $35,000, you subtract the $22,500, that brings her down to $32,000. So the government is not going to deduct the standard deduction of head of household of $18,350 from the full amount that she made, but it's going to do it from the lesser amount with that adjustment there. So 32,000 minus 18,350 brings her income down to $14,205. So in this circumstance, this person made $35,000, but because she's head of household and has a dependent and has an adjustment that she's making on that student loan interest, she actually, the government is going to say, we're only going to tax you on 14,000, not on the 35,000, right? So again, head of household was the best status for her to file because it enabled us to reduce her income by the most amount of that 18,300.
No.
So on the back of the return, we see, so she was making 14,000 whatever, right? She's pretty much in the 10% tax rate bracket. Just to keep things simple. So she owed on that 14,000, the government saying, all right, you owed us $1,477. Boom. Okay. That's what was her tax liability was for the year. However, she has a child tax credit, right, for her dependent. And so since a portion of it gets to cover whatever tax liability that she had, if the government is going to give her up to the amount, up to $2,000 of a non-refundable credit to apply towards her tax liability. So she owed the $1,477, but as you see in the yellow number 6, she's going to get the exact same amount in that child tax credit, which is now on line number 7. I'm sorry, line number 16, but point number 7. Her tax liability is 0, right? So that wiped out any tax liability she had owed on that $14,000 that she earned. Now, if you look at line 17 or point number 8, she had $4,216 taken out of her pay stub during the year, right? So she made $35,000 and $4,216 was taken out over the whole year to pay whatever tax liability she thought she was going to have. So clearly she way overpaid what her tax liability was, because her tax liability was 0, right, based on these calculations.
Yeah.
She's going to get all that money back, plus any additional tax credits that she's going to get. So if you look at line 18A or point number 9 in the box, she's going to get an earned income credit or earned income tax credit of $38. So even though she made $35,000 and had one qualifying child, she's qualified for the earned income tax credit and is get $838 of that credit in the form of a refund. Now, also, she's going to get an additional child tax credit, which is the refundable portion of the child tax credit.
Okay.
$523 based on her filing status and income and everything else and where she falls on the spectrum. And so when you add all that stuff up, we're going to get her total refund of the $5,577.
Wow, that's great news. That client must be happy.
Yeah. So she clearly, something that she should do, right, is she's getting paid $35,000 a year, but she's having about $4,200 taken out of her pay stub.
Yeah.
Well, if she's going to make the same amount next year, might as well keep that $4,200 and $4,216 in her pay stub, right, in her pocket. So go talk to an employer and say, hey, too much money is being taken out. I want to change my withholdings on the W-4 form, which is that first form we went over together in this podcast. She could change it to have less taken out during the year so that she had more in her pocket during the year to cover her expenses, so that she doesn't way overpay what her tax liability is. Some people, that's their way of saving, right? So when they get that $5,000 refund check, they can put it right towards, their car payments or the school that they're going to, or, it's their way of saving their money. And some people like to do it that way. It's a financially sound thing to do because you're basically just giving the money interest-free to the government to use during the year, when you could be using it yourself or putting it into a savings account or doing something else that you actually earn interest on. having a little bit taken out of your pay stub, you kind of forget about it. And it's a little bit easier than having to actually get more in your pay stub and then taking that money and putting in a bank account and watching that money disappear, or not disappear, go into the bank account that you're trying to tell yourself that you don't want to touch.
Yeah, makes sense.
Yeah, but so in this situation, right, her tax liability was wiped out by the child tax credit. She the money that she overpaid that was taken out of her pay stub, and then she qualified for the earned income tax credit and the additional child tax credit based on her filing status and the fact that she had a dependent, and therefore is getting back that refund of $5,577. So that's sort of a run through of how a tax return is calculated and how someone might qualify for different tax credits based on their situation.
What would be your suggestion when it comes to what you were talking about? Like is it better to overpay and make sure you're gonna get some money back the next year, or just to pay the minimum so you can see, like you just said, like more money in your paycheck every single month?
Yeah, it really depends on your discipline and your situation, right? So if you're making enough money that you're able to pay your bills, that if your car breaks down, you're able to pay your, your car bill and you're able to get to work again, whatever the situation is, as long as you're able to continue your life with minor hiccups, with not getting, slammed and sort of sent into a financial spiral, you can stand to have a little bit more taken out and then getting that in the form of a refund at the end of the year. The problem is it's just not good financial thinking because that extra money now is just sitting at the government's coffers, right?
Yeah.
And being used by an administration that most of us do not agree with. And it's just, you're not earning any, you're not making money from your money, right?
Yeah.
And there's an opportunity for you to save and put your money in a savings account or buy a CD or something like that. You start making money from that extra money that you're not using. Better decision.
Yeah.
And to keep it. Now, if that's not the case, right? You can't do that, and the stock market is going up and down and going crazy, and you're worried that you might need to access that money if your child, God forbid, has some accident and you need to pay some hospital bills, or you just end up racking up debt on a credit card, which has a very high interest rate.
Yeah.
You have to really think about all those situations and make the best decision where you're paying as little money on any debt that you have, making money on any savings that you might have. Hard thing to do, and most people are not in the situation to really strong understanding of what is the best thing for them during the year. So say you want to save up for that vacation to go to the Caribbean, well, have a little bit more taken out of your pay stub every month to get refund at the end of the year so that you have that chunk of change to buy those tickets. Maybe that's a good way to do it. But it really just, it's hard to say what's the best thing to do, but I want to think about not losing money to high interest debt, credit cards, but also you don't want to be giving your money to the government when you could be making money on that or using that for whatever expenses that you have.
Yeah.
So it's hard to say. I find, like sometimes when I work and get a 1099 miscellaneous, that form like a contractor where I perform some type.
Yeah, the 1099, yeah.
Right, I'm not going to have any taxes taken out. So sometimes when I know that I might have a job or two like that during the year, I'll actually have a little additional money taken out of my W-2 job, right? The job that I'm getting paid every 2 weeks on.
Mm-hmm.
Know that I'm getting too much taken out of that wages because I'll basically have more taken out than what I'll owe on that wage. But I'll know that extra money can now get applied towards my tax liability with that contractor 1099 miscellaneous income. to sort of play things against each other in order to not be stuck with a huge bill when you have to file your taxes. That's often what sends people into a spiral.
Yeah, true.
They're like, oh my God, I totally forgot. Now I owe all this money and I don't have this money and I can't get this money together. And now I have to pay some penalties and late fees and interest on this that I owe the government. And it's just not, and nobody likes owing the government because the IRS can, they can take your bank accounts, right? They have access to what you have. So it's just not a good feeling knowing that they have that much power over you.
Yeah, true.
So, yeah. Anyways, that's a rundown of how sort of taxes work, and it's sort of a generic, simplified situation that someone's in. As you can see here online, like 21, I think B and C, there's those digits there in red in the middle of the page. That is direct deposit, having somebody's bank account and routing number. We really recommend that folks not get a paper check from the government because it takes a lot longer to get it. And then like we're in the situation that we're in now, right? We're in a time when the government is giving these stimulus checks. Well, if they have your direct deposit, they can get you that money a lot faster. So, and this way, you don't have to pay check cashing fees, right? You're getting that money directly into an account. And at our tax sites, we offer a free debit card. And we also offer a debit card for a savings account with a local credit union. So there's different options. And because that's the fastest and safest way, no one can steal your check, right? That money is just going to go directly into your account. That's the best way when you do a refund. So finally here, this year, because of the pandemic, the IRS has extended the filing deadline. So this year, anybody who owes money, right, is due to file on July 15th, 2020. So this summer, July 15th, that is due. So if the government owes you a refund, well, that deadline doesn't apply to you, right? Because now the government's just keeping the money that they owe you, and they're happy to do that, right? That's more money in their pockets. Anybody who owes the government money, well, now that due date for this year, and it's just this year, is 2020. Normally, the deadline is April 15th or thereabout. Give a day or two, depending if it falls on a weekend or a holiday. But it's April 15th normally to file a tax return for any person who owes government money or runs a business or anything like that. Just to give you an idea, so I mentioned in the beginning that we have tax sites, 20 in Philadelphia, and then 15 outside in the counties as well as southern New Jersey. So if you go to our website, we've got little drop-down menus that you can click to find out where the different are either in your county or in your neighborhood. And we've broken it sort of generally down, Germantown, North Philadelphia. And then the same with New Jersey, we have it broken down by the different counties that we operate. Now, with the state and mayor's office shutting down most businesses recently because of the pandemic that we're all experiencing, we have explored and have launched a virtual tax prep option where folks get to, as long as they access the internet, they have a smartphone, computer with their tax documents on it, which is less of the case, but as long as you have a smartphone, you can complete an online application. You can upload all your documents by taking pictures of them and sending them up, and it's very easy to do. You get sent these links to help you do it. It's quite easy, but still requires a certain level of technical savvy. But you can do your taxes still with us, even with our tax sites closed, by going to our website and choosing the virtual tax prep option. We've filed over 100 and something returns so far. And most folks are finding it quite easy to do. It's just a matter of having all your tax documents together and use your smartphone to take. upload those documents.
So no phone calls then to set up appointments or like virtual appointments. They gotta go straight to the website
Yeah, so
and fill out this virtual tax preparation form.
yeah, so actually all of our tax sites, the majority of them do not operate by appointment. Everything is first come, first serve.
Oh, okay.
This virtual tax prep option is the same thing, right? It's just you do it from your couch, you sit down, you do your documents, upload it. Once we have everything and we're ready to begin, we contact you and say, hey, let's talk about what you have. Let's make sure we have everything. Then we prepare the return, and then we'll contact you again. Someone else will within our organization to review that return with you. And I didn't really talk about that, but maybe this will help your clients gain a little bit of confidence in us, is that we always have 2 people reviewing every return in order to make sure that as few mistakes are made, because one person who prepares it might not review it as well, or review their own work as well. So we always have a second person, someone else's work. And so,
Wow, that's great.
yeah, so if you do have if you do use the virtual tax prep option, or you're at a tax site, you'll always deal with at least 2 people when they're preparing your return. Last year, I think our accuracy rate was like 90%.
Oh, wow.
So
That's a good number.
yeah, very few mistakes are made. So you should feel confident filing with us. And that's it. So if you have any questions, Luisela, or
Yeah, well, I wanted to ask you in case since this video, like I told you before we started making this video, it's gonna be posted on the NSC Employment Services blog and the YouTube channel. If they, any of the clients or even the case managers, because they also gonna have access to this information as well. So if they have any further questions, what is the best way to contact any of you? I don't know if it has to be through you or any other members of the organization.
Well, so I mean, you're more than welcome to supply my email. Folks, if they go to our website, there's an ability to submit questions through our website. Those actually go to my email or to an email that I check, so I will likely respond to those. And our office lines still go to our cell phones, even though we're working from home right now. But I do recommend, and it makes sense just because you and I know each other, we're in communication, that folks do reach out to me, and I'll do my best to answer their questions. They're directly through an email, or if they call and leave a voicemail, to as timely respond to that voicemail. Email, of course, is probably the fastest way.
Yeah. Okay, perfect. Yeah, I didn't want to forget to ask you that. So I think that that be all. I think you covered a lot. I mean, this is the reason why you and I call this video Taxes 101, because it really gives you the fundamentals of the taxes in the United States. I really hope that this information that you shared today, it will be very helpful for our clients. So thank you so much, Jonathan, for joining us, and looking forward to also share some time with you in about 2 weeks, I guess, by the end of May. Perfect. Yeah. So you can, so you can provide some of this information to the Job Club students. So thank you so much. I appreciate it, and thank you all for watching this video. And like we said before, if you want to reach out because you guys have additional questions, probably some of you will, since this is a very dense topic. So do not hesitate to contact me, and I will gladly give you the information. Thank you so much. Bye-bye.
Okay, Luisela, bye.
Bye.